All right. Well, thank you all so much for being here. Good morning. My name is Shannon Ward, and I'm the Chief Revenue Officer here at Genus Capital. We're particularly excited for this event because this is the first year in review event that we've been able to hold in person since 2019 or 2020. Can't remember which one it was. We're also quite excited because we have everyone, all your lovely faces in the room today, and we also have over 200 people joining us via live stream today. So welcome to all of the live stream people as well. So happy to have you all with us. This is an exciting day as it's our first, like I said, our first hybrid event in many years. So also, please bear with us as it's our first hybrid event in many years. I'm sure everything will go great, but so I will be your host for today's session, and I'm joined today by a wonderful panel of speakers that I have, my colleagues over to my right. We have Wachell, our Executive Chairperson and Co-Chief Investment Officer, Mike Thiessen, our Chief Sustainability Officer and Co-Chief Investment Officer, Justin Hahn, our macro analyst, and we're also happy to be joined by Sebastien, Rheaume, managing partner from Alpha Fix, and Alpha Fix is our fixed income sub-advisor. So I'd like to also take the opportunity, since we are all physically in the room together, to just highlight the portfolio managers who are also in the room so that you can start to put names to faces. So first of all, I'd like to introduce Jill Bester. If you just want to stand for a second, Jill Bester, and Grant Conroy is here. Grant, Thomas Irwin, and Ian Lusher, Mary Lou Miles, Sue Talbot, and Stephanie Chu. Excellent, thanks. Now we're also really glad to have our client service team here. So some of those people you may not have met, and again, it's great to be able to put faces to names for people who you may deal with on a day-to-day basis. So our client service team, we have Amy Coots. Where are you, Amy? It's very bright. Okay, she's not here. She will be here. Arthur Ho. Arthur's in the back there. Thanks, Arthur. Batul Tijani. There's Batul in the back. Evelyn Wu in the back as well. And our newest client service team member, Carol Nagay. Okay, she's downstairs, making sure that people make their way here successfully. So today we're going to do a few things. We're going to explore some of the key events that happened in 2023 that shaped the markets, that shaped what happened in your portfolios. And we're also going to strive to provide some of our insights as to what we think will occur in 2023 and how we plan on reacting to that and managing your portfolios accordingly. For those of you joining us via live stream, we will get started with the presentations shortly, but I just wanted to take care of a couple of housekeeping items before we get going because we do have the two groups. So the first thing is, if you are on the live stream and you have any technical issues, please just put your technical issue, type it into the chat, and we have someone on hand that will be able to help you to sort that issue out. Also, please put your Zoom on speaker mode. That is the best way to be able to see the presentation. Now, we have a really cool way of doing Q&A today. So we will have a question and answer session after the presentation. And I just wanted to note now that there are a few ways that you can submit questions so that you can submit your questions throughout and you don't have to wait till the end. So the first way, there's actually 3 ways that you can do it. So the first way that you can do it is you can use the QR code that's on the screen there. And you can submit a question anytime during the presentation using that QR code. Now, for those in the room, you can do that on your phone as well. And for those at home, you can use the QR code from home. You can also, if you prefer, use the link and the ID number that is there. So if you don't want to use the QR code or you're not familiar with QR codes, you can just go to slido.com and then enter the number there and you'll be able to enter your questions as well. Now you can do that again anytime during the presentation. And for those of us joining in person, during the actual question and answer period, we will have a microphone that will be roaming. So if you prefer to hold your questions until then, we can come over to you during that time. A recording of today's session will be made available to all of you, whether you are in person or live stream, and anyone who registered and if they couldn't be here today. It'll also appear on our website, so if you'd like to share it with friends and family, feel free to do so. Before we get into the presentation, I just want to start by extending my gratitude to the Indigenous peoples, specifically the Coast Salish, Tsleil-Waututh, Squamish, and Musqueam nations, on whose lands we are honored to be gathering today and speaking to you from. We do this to reaffirm our commitment and our appreciation to improving relationships between nations and including and improving our own understanding of local Indigenous cultures. We're grateful to have the opportunity to live, work, and play on this territory. So before we get into the actual meat of the presentation with the speakers here, I would like to give a few minutes over to our Chief Executive Officer, Stephen Au, who would like to also welcome you and say a few words.
Thank you. Thank you, Shannon. Good morning, everybody. I want to extend my warmest welcome to everybody joining us both live stream and in person. For those in the room today, it's 3 years in the making, and it's a pleasure hosting you once again. Leslie would often say at these events how much we appreciate your choice in choosing Genus. And truly, it's your trust and continued support that we value very much. So thank you very much. I recognize that I've had the opportunity over the years to say hello to a number of you, but for the vast majority, I'm a somewhat familiar but new face. Before taking on my role as CEO, I served as the firm's Chief Operating Officer, Chief Financial Officer, and Chief Compliance Officer. So after 21 years, I've been working behind the scenes to support the team and your success. Not much has changed. I'm not managing your money anytime soon. It's our investment team over there that's going to be doing that. My number one priority is making sure that our teams are well positioned to deliver on your investment needs. And that hasn't changed, and it won't change. So thank you for that. Before we turn over to the economic part of our update, I do want to share something that we are very proud of at Genus, and that's us being a certified B Corporation. A certified B Corporation is a leader when it comes to promoting a economy that's built around inclusion, equity, and sustainability. And so we're very proud of that. In 2017, we undergo a very rigorous process of certification, and we achieved a score of 88.8 on our first try. Fast forward a few years, in 2021, we recertified with a 36% increase in our score to 121, and we've still got a lot of work left, but we're very happy with that. Last year, the B Corp recognized Genus as one of the best for the world in the customer category, and we're very proud of that. One of the reasons why we do score well on these tests really is our diversity and inclusion across all areas of the firm, from management all the way to employees. At Genus today, 53% of Genus is owned by women. Our workforce is equally 50-50 men and women, of which 63% identify as diverse. I haven't cleared this with compliance yet, but I'm gonna stick my neck out and say that is probably rare in our industry. And it's something that, it's a testament to our founders, Wayne and Leslie, and it's a value that we basically will take into our future as we look into what's next. Speaking of which, we turn our attention back to the economic forecast and take a look at what's happening this morning. So Justin's going to start us off by taking a look at the actions of the central bank and why we think those actions in 2022 is really going to kick off a recession this year. Wachell will follow up Justin and talk about some of the major changes we're seeing in the markets. And Sebastien from Alpha Fix was here to apply a fixed income lens so for us to understand what happened in the past and what do we expect going forward. Mike Thiessen's going to shift a little bit and take a look at the innovations that we're seeing in the sustainable and impact space. So thank you once again. And to kick us off, Justin Hahn.
Thanks, Steve. So, as Steve mentioned, my name is Justin, and I'm a macro strategist here at Genus Capital. Today I'll be reviewing what happened last year and what we expect going forward. So last year we saw historically high inflation rates, where we saw inflation all the way up to 6 and 7%. This was the highest that we've seen in the last 40 years. And as a reaction, we saw central banks increase their interest rates as well as lower their balance sheets and stop printing money as fast. As a reaction to this, we saw valuations in the both equity and bond markets go down in a very anomalous year where both fell together. And we think that all this will cause a recession later this year and into next year. But there are some hopes that and optimisms that it will be a shallow recession because we are seeing signs that inflation is slowing down and has peaked. So looking at this chart, we can see that usually the end of a bull market cycle is marked by high inflation rates, which we have seen last year. And then it goes forward because it pushes the central banks into a corner and they're forced to tighten their monetary policies. I'll be going over the first 4 steps that we viewed and we've seen during last year, starting with the high inflation rates, and then moving on to central bank tightening, which we've seen through interest rate policies. And then we've also seen equities and bonds fall due to these higher interest rates. And then we'll finally show some signs that the economy is slowing down and headed towards a recession. So from this chart, inflation last year was caused by the fiscal stimulus that was fiscal stimulus in order to help prevent the economic collapse during COVID. So we can see that debt to GDP levels over here in the US and Japan have hit above 100%. Back in the 90s, these levels were hovering around 50%. Canada did fare a bit better here. We can see they've been below 50% for the last 20 years. And these numbers were spiked due to the fiscal stimulus through direct checks and other policies. So from this chart, we can see that the US debt to GDP has benefited the most from inflation because the central banks were able to monetize that debt, and this level has come down. Canada has also come down, but Japan still remains a bit elevated here due to them still giving stimulus to their economy. So as a result, we have seen the consumers be hit, even though it has benefited the governments. You've experienced this in your everyday life where it comes to groceries and gas or leisure and travel. We've all felt the impacts of higher inflation rates during last year. This is in part due to inflation, wages not adjusting and keeping up with the pace of inflation that we've seen. We've seen that inflation rates here have really taken away from the wage growth that we saw during the fiscal stimulus through direct checks and higher raises last year. Because of the high inflation, we have seen central banks take action because they were forced to. Interest rates are the highest than we've seen in the last 15 years. Interest rates are both currently sitting at around 4.5% for Canada and the US. And as the central banks rose rates almost every month all throughout last year. In addition to the higher interest rates, we have seen central banks lower their balance sheets. So this chart is just showing the year-over-year growth of the balance sheets from central banks, and then we've seen that a similar spike that we saw during 2008 and 2009, where the governments were issuing a lot of debt in order to help stimulate the economy, give direct checks, and do other funding methods. But that has gone negative this year. As a result of not buying as much government bonds, the governments didn't have to print central banks didn't have to print as much money either. We can see from this chart here, the orange line represents the global money supply, which in short just represents the amount of money that's circulating in the economy. And the growth rate is currently sitting at about 5%, where it hit the peaks of about 15% earlier during COVID. This level is also very heavily inflated by China and Japan. Those governments are still stimulating the economy and trying to keep their economy afloat. In both the US and Canada, the rates have gone down to about 0%, so stagnant growth of money. We can also see that this orange line is very correlated with this blue line. The blue line represents the global PMIs, which is the Purchasing Manager Index, which in short just represents corporate sentiment. Whenever this sentiment measure goes above 50, it means that the economy is in an expansionary territory, and whenever it hits below 50, it means that's in a contractionary territory. Currently, we're sitting just below 50, and money supply growth is pointing towards lower growth for the economy. So We can see the direct impacts in terms of valuations in the capital markets. Home sales are the most directly impacted by higher interest rates. We can see that home sales on a year-over-year basis have shrunk into the negatives and have been going down. We see that big spike over here during 2001. This is due to the historically low interest rates and borrowing costs that we've seen. So a lot of people were buying homes, which is why home prices shot up. But we expect this to continue to be slow into this year as well. And this story is similar in Canada as well, even though this just shows the US numbers. It was also a very strange year, a very unusual year that we saw. We saw bonds also fall along with equities. So this chart shows the drawdown in bond rates, bond returns. So we can see that the last time we've got such a correction in bond market was during 1978 and during the 1981 recession, which was caused again by high inflation rates during the Iranian Revolution, which caused a global shock in energy prices. So we can see here from this chart that bonds have really come down quite a bit since last year. In addition to this, we also saw equity markets take a huge hit. So this next chart represents the price to earnings ratio of the S&P 500, and we can see that it has come down to about 15, which is where it was pre-COVID levels after spiking all throughout last year, the year before. We use these 2-year forward earnings for this chart, which represents the 2024 earnings. We use this chart because we use this rather than 2023 earnings because it's a more smooth line of what we usually see in the markets for analyst expectations. So we can also see that it is not as low as we've seen during 2008 and 2009, where it hit single-digit valuations. So it's still more fairly valued than looks cheap for us. Because of all this interest rate policy shifts as well as quantitative tightening and the correction that we've seen in both the equity and bond market, we expect that there will be a recession most likely coming later this year. This chart here represents the 3-month bond yields in the US relative to the 30-year bond yields. And whenever this signal hits 1, it's been a pretty good predictor in terms of when a recession is coming. So from this chart, we can see that it has hit it 6 times in the last 50 years, and this being the 7th time it's hit. The one thing this chart doesn't show you or tell us is how deep the recession will be. We can see it could be a short technical recession that we saw during COVID, or it could be a very long, drawn-out one during 2008 and 2009, where you see a bit thicker of a green bar there. Interest rates generally are a good indicator in terms of when recessions are coming, and they usually lead or lag the economy by about 12 to 18 months. This is another model that we have that's based on short-term and long-term interest rates for the developed and developing market economies. It's just a model built on those rates that have been lagged about 12 to 18 months. We can see that it is also pointing towards a recession, which is that dotted line, and then the bolded orange line represents the PMIs that I mentioned before, which is just corporate sentiment, which shows that it is headed lower later into this year as well. This isn't all bad news, though. We are seeing lots of positives that could point towards a more shallow recession for the governments. So we can see that inflation has peaked last year. The blue line represents the CPI numbers, and the orange line over here represents the 3-month annualized rate of CPI. So 3-month annual rate is just we're just taking October, November, and December's inflation numbers, and then we're annualizing it, and we can see that the number is at 3%, which is close to the central bank's target of 2%. Money supply is also pointing towards lower inflation as well. From this chart, you can really tell that inflation is a monetary phenomenon, and we can see it's just too much money chasing too little goods, which causes inflation here. So money aggregates in the purple over here just represent the year-over-year money supply growth. As I mentioned before, in the US, money supply growth is around 0% versus all the measures of inflation. So CPI is just the consumer index, PPI is just the producer index, and PCE is just the core inflation measure that the US Federal Reserve uses in order to gauge the economy. So we can see that it all peaked around mid of last year, and we expect it to continue to fall further into this year. So to summarize what we've been through, we've seen inflation rates hit the highest in the last 40 years. And as a result, we've seen central banks partake in quantitative tightening through, number one, raising interest rates, number two, stopping the government debt purchases, and number three, slowing down their printing of money. As a result of this, we saw home prices fall, we saw bonds fall, and equities fall in a very unusual year that we usually don't see. And because of all these things, we expect a recession will be coming later this year and into next year as well. But there is lots of optimism for a shallower recession for this year. We see inflation peaking, which will allow the U.S. Federal Reserves as well as the other central banks to take their foot off the gas and put a hard brake on their current quantitative tightening. This will allow the Fed to, the central banks to ease the economy into a soft landing, which has been said a lot. So now I'll pass it over to Wayne, who will talk more about the internals of the market and what we're seeing there.
Thanks, Justin. This is the clicker, I take it. Okay, that's a good start. And I can't read my notes here, it's so dark, so I'm just going to have to wing it, I guess. Here we go. Well, welcome, everybody. I'm going to start off, just give a quick recap of last year. Last year, we started the year a bit overweight in equities. We were kind of positive. And through the course of the early part of the year, we saw inflation come in, as Justin outlined, and Fed policy become more aggressive. And that triggered our models. Higher interest rates and corporate spreads getting blown out started triggering our models to become a sell. Through the course of the year, we started reducing equity, and by October, we were about 10% below our benchmark weighting in equity, and on a risk-adjusted basis, about 17%. So we were quite defensive through the course, became more defensive through the course of the year. In the fourth quarter, we started to see signs, as Justin outlined, of inflation starting to peak, and it has peaked, we believe, and is turning down. And that triggered interest rates to come lower, spreads to compress a bit more, and the US dollar to peak. That helped our models become more positive. So we started buying more equities in early December, and then in the first part of this year, which you won't see in your quarterly report yet, we bought more equities. And so I'll get and explain now what our thinking is in terms of going forward and where we go from here. The bear market and the concerns of a recession are masking three big changes we're seeing right now, for example. So number one is that bonds are back. Government bonds especially, have been really expensive. Their yields have been very low for 12 years. And they're back, they're more attractive now. The next big thing is we're seeing international markets become more attractive. I'll talk more about the details on that. And the third is that value stocks, after underperforming for 10 years, are making a comeback. And we think they have more legs going forward here. So, and finally, where we sit right now, where we're going, right now we're neutral in equity, we're overweight bonds, we still see some upside there, and we're underweight, we spent all our cash, we're underweight in cash. Now, you're probably thinking, well, Justin's calling for a recession. Wayne's saying we're buying more equities. We're talking out of both sides of our mouth. What's going on here? Well, let me explain our perspective here is. Number one, our models have, we built our models back tested on history. They've gone positive, and they're predicated on what's going on in the market in terms of interest rates coming down, spreads being sort of a risk-on type environment. But as Justin said, right now we're looking at a shallow recession. Now, even if we get a hard landing, when you go into the current phase we're in right now, where the Fed starts to pivot into lower interest rates, you'll get 20% rallies, and they can be quite robust. And I can remind you, back in June of 2008, the TSX hit an all-time high. So even if we get a hard landing, we think we're going to get a rally here. Whether it's soft or hard, our models are saying go long. And we're nimble enough, we believe, we have the signals and information to become more defensive if we are going into a hard landing. We have time, is what we're saying. But right now, the markets look a little more positive on the equity side. And so that's why we're becoming a bit more bullish and going back for neutral equity weighting. And I'll remind you that even with a neutral equity weighting, because we have so much dividend strategy in most client portfolios, our risk-adjusted equity weight is still about 7% below the benchmark. So we have a bit of risk insurance in there, if you will. So let me tell you more. As I mentioned, we started showing this chart here back around 2011, 2012, when interest rates went so low because the governments were coming in, central banks were coming in and buying bonds and driving down real rates. Real rates are simply the difference between a bond nominal yield and inflation. And we get this number here from the Treasury index bonds, which you can basically go out and buy a bond that gives you a percentage return above inflation. And right now, so it went below 1% in 2011. It stayed there for 12 years effectively. And every year during our client seminars, clients would ask me, Wayne, are we ever going to leave the new normal? Are we still in it? We were still in it. And we're finally out of it now. And the reason we're out of it, I believe, is that because inflation is now a threat, governments have spent all the money, and they can't just print money ad nauseum and buy bonds. And we saw a bit of the action during the fiasco in the UK, where the government came in with these wacky policies to control inflation, but also stimulate at the same time, where the bond market got involved. And actually, the bond vigilantes came back. And that was the first time we saw bond vigilantes since probably the 80s. And they came in and just pushed rates high and forced the government to backtrack. We may see more of that in the future too, I believe. The bond vigilantes may be back, which may be a good thing. They might apply disciplines to our spendthrift governments. So we're back in the old normal. That's a good thing. The good news here is that investors will get a decent return on their bonds now. So bonds are back. The risk here could it be during this transition from the easy money, new normal, back to the old normal, there's going to be some adjustments in the capital markets, because we're going into a period now where this hurdle rate, this bond yield here, will affect all hurdle rates across the corporate sector, governments, and everywhere else. So this is the risk-free rate. It's going to impact the cost of capital across the whole market. So there could be some issues around transition. We're going to see. Another thing we're seeing right here now too is that, and why I think our models are going positive, and why the market's getting a little frisky here, is that the bond market is more optimistic than the Fed. You can see in the far left, that's the year-end unemployment rate is higher. Consensus is much higher than the Fed. The core inflation rate is lower than the Fed. And the Fed's fund projected for end of year is lower than the Fed. So the bond market's more optimistic. And usually, and this is often classic Fed behavior, central bank behavior. They talk tough, they jawbone, they want inflation down, they're going to talk tough. One day they will come out of the room and say, we're pivoting. So they're going to talk tough until they don't talk tough. So take that with a grain of salt. Another positive thing is the U.S. dollar has peaked. And when the U.S. dollar rises, and it rose 20% this year, and usually when it rises 20%, it squeezes the economy and often breaks things. And I think it's breaking some things right now in emerging markets. So it's peaked, it's coming off. That's a good thing for the international markets, for the rest of the world, because commodities, oil, gold are all priced in U.S. dollars. So when the euro is going up, the price of oil is going down. So that's helping the European economies right now. So this is a positive thing from our perspective. If you look at U.S. earnings, U.S. margins, this is profit margins. This is the EBITDA, earnings before interest and tax. It was very high during the last decade, running around 16-17%, and that was a function of globalization and using corporations using technology and the whole technology move. Went down during 2019 and went to new highs here, I think driven primarily by technology, and it started to roll over. And we think this has more legs. We're going to get a bit of an earnings recession here. It could go down to 15 or 14 and drive earnings down maybe 15%, 20%, which would be normal in a recession. So we think margins are rolling over. We're going to see more evidence of that going forward. If you look at U.S. earnings versus the rest of the world, This is year-over-year change of U.S. earnings versus rest of world earnings. And you can see the red line. You can see through the course of the last decade, U.S. earnings have been, the median's been around 5% higher than the rest of the world. And right now, it's actually minus 15. So the first time in over 12 years, the U.S. is losing momentum big time to the rest of the world. If you look at valuations, we look at valuations based on interest rates in each market, and we look at earnings yield relative to bond, so simply earnings yield minus bond yield. Earnings yield is simply the reverse of the price-earnings ratio. So you take earnings divided by price, subtract from bond yields, and you get a number. And right now, the number is around 2% in the U.S., making it expensive. Canada looks like it's fair value, as does the U.S. So we're seeing not just earnings momentum, just better, but also better value in the international markets versus the U.S. We're also getting some price confirmation as well. European stocks have been in a downtrend versus the U.S. for the past 10 years. This is the Euro stock, the stock 600. It's the big 600 stocks in the U.S. and it's breaking out. So we're getting confirmation. So we're getting better value, better momentum, weaker U.S. dollar, and price confirmation that the international side is picking up and doing better than the U.S. Now, looking to value has been really underperforming for 10 years. As rates have gone down, it's hurt value investing. Value investing is looking at companies that have cash flows, and you discount that with some rate. And as the rates have dropped to almost zero, the number you're discounting with is very, very low, and that puts more value on the long duration companies like tech companies versus the cash flow generating companies. And a lot of value managers, or some value managers in 2020 and 2021 just threw the towel in because was like 10 years of underperforming. It's turning around now. They're starting to outperform growth. Values are outperforming growth as interest rates go up. And we think with the higher rates and with what's happening in the economy, with more inflation than we had in the past decade, it's going to help asset values and help value investing versus growth. And if you look at value versus the overall market, value stocks are still dirt cheap. If you look at, Justin showed you a chart where the FY2, basically 2024 earnings, the multiple on that is around 15 times. So this chart is saying that the difference between the market and value stocks is around, say, 8 points. So the market would have an overall price earnings ratio of 15. Value would have around 7. So they're still dirt cheap, and we think they have more momentum or wind at their back with higher interest rates. So Justin showed you the chart here of bear market process and talked about the first half. And I'm going to talk more about, I've been talking more about the back half in terms of what's happening in the corporate sector and in the markets. The first half of the bear market process is driven by markets. It's more about the markets, about the Fed and markets. And the Fed raising rates, the markets selling off, repricing. So bonds repriced, stock repriced. The second half of this saga is about what happens in the real economy. And that's going to hit us in about a quarter or two. And so what's going to happen then? And we don't know what's going to happen then, really. Things often get broken. You get credit risk, you get liquidity risks. And we don't know yet. But right now, it looks like like a shallow recession. And the reason we say that because there was a lot of we think corporate balance sheets are in better shape than they were, back in the Great Recession. A lot of corporations got their balance sheets in order during the pandemic recession. So we don't know what's going to happen here until it actually happens. We have to go through this valley of economic underperformance, but the market has discounted a lot of that already, and that's what we're saying. And they're saying rates are peak basically. They're going to be coming down. That's a good thing for markets. And so the question is, what happens to the real economy? We don't know that yet. We'll be watching that. And there could be a negative feedback loop like we saw in 2008, where the market went to new highs in early 2008, and then the economy was into recession. We all knew that, but things got broken, namely Lehman Brothers, for example, and that caused another downdraft. So we're aware of that. We're watching our signals, and we'll see where that takes us. So here's our model recommendations. You can see the top left, our cash, the yellow, is underweight. The green is next to this bonds. We're overweight bonds. And within bonds, we're moving into more corporates. Yields are still attractive there, both in Canada and the US. And looking at, models are also favoring commodities, gold and oil. And copper moved from being a negative to a buy, and that's usually a good sign of the economy, we think, or the history proves that. And within currencies, the Canadian dollar and euro are favored in our model, and so we're moving towards more overweighting the Canadian dollar and the euro versus the US dollar. And this is the first time this happened in a long time. Looking at equities, we're neutral in equities. Within equities, our S&P 500 models have gone negative versus the rest of the world. That's the first time in a long time. And our EFA models have gone positive. The emerging market has gone from negative to neutral, and our models are favoring value over growth at this point in time. Looking at our balanced fund, this is our balanced fund as of January 16th, not December 31st. And where we sit at the year end, we were at 60. So we started the year, as I mentioned earlier on, at 70% in equity, went down to as low as 55 in October, ended the year at 60, and we're now at 65 overall equity. And we've invested all our cash, as you can see. Our fixed income is at 28 points, almost 29 versus the benchmark at 25. And we're market weight in commodities. And at the very bottom, you can see our risk-adjusted equity weight there, which takes into account the lower risk bond dividend strategies most of you have in your portfolios. And that's around 58% as we speak right now. That got down as low as 47 going into October. So we were becoming more defensive through the course of last year, and then we're back to a market weight in stocks right now, and we'll see where it goes. And we'll be looking at our signals, watching the market. We're optimistic. We're going to get a bit of a rally here. And we're watching. We're always paranoid about things breaking in the economy, and we'll be watching that and also watching our models. So in review, the bear market is halfway through, we believe. It's masking some big changes. Basically, bonds are back after being government bonds are back, being unattractive for 12 years. International markets are looking much better with the U.S. peak in the U.S. dollar, better value and stronger earnings momentum, and value is looking better for the first time in a long time. And we're neutral, watching our signals. And as I mentioned before, at this point in time in a cycle, typically when you get a Fed pivot, you get a rally, even if you get a hard landing later on. And we don't think that's going to happen, but we'll be watching and waiting and watching our signals and watching for any more volatility and chop. But for right now, we're a little more optimistic. And with that, I'll pass it off to Sebastien to talk more about bonds.
Thank you, Wayne. Thank you for including us. It's always a pleasure to be in Vancouver, especially when there's a big snowstorm in Montreal. So I'm happy that Wayne says that finally bonds are becoming to be attractive after 10 years of being unattractive. So I'm happy to be here to talk a little bit about that. Just before I get into the presentation, just a quick overview of who AlphaFix is. So my name's Sebastien Rheaume. I'm a co-founder of AlphaFix. So we're one of the few remaining independent fixed income managers in Canada with a very, very focused and niche business plan. So we basically do only fixed income for institutional clients. I think we have one of the stronger teams in fixed income, and I'm always surprised to see when you combine a very strong team and a very, very focused business plan, how much you can innovate. And we certainly have innovated quite a bit since we launched the firm in 2008. We were a very early adopter of integrating ESG criteria within our analysis. And then we brought that to the next step. We launched the first impact fund in Canada in 2017, the Green Bond Fund, and we continue to innovate. So we'll have a lot of really, really interesting stories to keep on telling you guys year after year. Canada has big challenges in terms of decarbonizing the economy, and I think as a manager, we could actually have a very proactive role to play in getting Canada in a better space. So now, both Justin and Wayne have told you the story of fixed income. So it's been the worst year since we've have recorded the performance in fixed income, and it's a combination of rising rates. So obviously rates have gone up quite a bit, but also the fact that we started 2022 with very, very low rates. So we started the year probably with average yields of 2%, and that average or starting point is really important because that gives you the protection for higher rates. So if you start at 2% and rates go up, it's really very, very difficult in fixed income to hide and have anything other than negative returns. So we highlight here all the different mandates that we manage for Genus, and the bad news is that the negative returns across the board. The good news, if there's such good news like this, is that we've managed to do better than the index on a relative basis. So we were able to position the portfolio for rising rates in 2022. So we were able to have a positive value add versus the benchmark. So that's kind of the silver lining in this story. The other point I want to highlight in this slide is if you look at the completely right-hand side. Like I said, we really believe we have a role to play in getting the carbon intensity of the economy lower, and you can see how much we've reduced the carbon intensity in all of the portfolios that we manage. This is across Alpha Fix, but also clearly for Genus. And I just want to put a little emphasis on the one that's in green there, so the green fossil-free corporate bond fund. So 2022, if you didn't have any exposure to the oil sector, was a difficult year. And the point I want to make is that within the world of fixed income, we actually managed to do quite well. So even in a year where we had this huge front wind, we were able to do quite well relative to the index. And the message is really, we get this question often, am I subsidizing a subpar strategy by going fossil fuel free? Well, clearly 2022 is a really good example in the fixed income world where we have other tools that we can use to substitute value adds, and clearly we were able to do that. So again, kind of good news, bad news. Bad news is it was a difficult year. The good news is that we actually did okay versus the benchmarks in across the different strategies. So how did we do this? So the green line here that I'm showing is basically the evolution of the 10-year bond. So you can see it started at 1.5 and finished close to 3.5. So almost 2% increase in yields. It's quite significant in the world of fixed income. And the black line gives you how we kind of manage. So the black line is the relative sensitivity of our portfolios versus the benchmark. So it's all about duration. So we were positioned for higher rates. So you see on the right axis that we had a lower duration versus the benchmarks. So we were a little bit, we're short almost a year versus the benchmarks. And you can see what we did at the tail end of the year. We actually reduced that gap. And it's really, both Justin and Wayne explained the scenario of 2022 and where we're going in 2023, right? So rates have risen quite a bit. And if we do see a slowdown, which there's no reason to believe we wouldn't see a slowdown, probably we've maxed the higher rates. So now we want to take away some of that risk that we had and increase the duration and increase the sensitivity of the portfolios to rates, because if we do have a recession, then we should see lower rates, and then we want to capitalize on that. So that's the essence of how we were able to create value add in 2022, was having lower duration versus the benchmarks. And like I said, that risk has been removed towards the end of the year to reflect the reality that 2023 is going to be probably a year where fixed income should have a positive return versus 2022 and 2021. I also wanted to give some specific examples, because the impact investing is always a challenge, and obviously we only do it in fixed income. And the beauty of fixed income is that we have what we call use of proceeds bonds. So we could actually lend money to companies, and they will take that money and dedicate it to some specific projects. So that's quite unique to the fixed income world. So I've highlighted here 3 different bonds, because there's 3 different types of bonds that we can invest in that have impact bonds. The first is the one I have here is social bonds. So this is Morgan Stanley, and it has to do with affordable housing, and it's a really neat project. So it's a 76 unit property in Washington, and it's really targeted to homeless people. But it's not just providing affordable housing; it's also giving them support so we could reintegrate them into the economy, into all the social nets that are out there. So you can kind of see the impact it has in terms of the SDGs. And the beauty again of impact investing in fixed income is that if we were to lend against this project, to be quite honest, it would be very difficult, because the credit risk would be obviously fairly high. So the credit risk of this project is not the actual building apartment, it's Morgan Stanley. So The risk is the Morgan Stanley risk, which is a good credit, maybe not the best, but it's a good credit. We're comfortable with it. And then they take that money and they dedicate it to this kind of project. So that's what we do in terms of impact investing. So we could actually dedicate funds, and then the issuers need to keep on tracking those funds. So social bonds is one category of bonds that we look at. The second category is green bonds, and I think we've showed this in previous years. So this is all about reducing the carbon intensity within the portfolios, and again, trying to get to an economy that's more balanced. So here again, just an example, Allied Properties. This is one of the projects that they went on to reduce the intensity of the use of power. So you can kind of see the metrics. It's kind of cool. So in terms of impact, so it's 34 million less of tons of CO2 per $1 million invested. That's about 400 less cars on the road. So, you know, it's a very tangible way to look at it. And also in terms of power, it's like the equivalent again of 300 households that consume. So very tangible. And again, you can see the impact in terms of the SDGs. The last category, so social, green, and then we call it sustainable, which is a combination of social and green. So sustainable bonds, again, it's an ability to do a bit of both. So here we show BCE, again, so it's always the risk that we're taking as a lender. So in both cases, Morgan Stanley, Allied Property, BCE. So BCE has issued a sustainable bond, which was basically directed to two specific projects. The first project was about energy efficiency, so pushing fiber further in the curb, reducing the use of energy, part of the 50% of the proceeds, and the other one is just affordable basic infrastructure, so providing broadband access to remote areas. And again, you could see the impacts in terms of energy, so 700 citizens in terms of capacity, and then also in terms of the impact on the connectivity. So again, this is the beauty of having the ability to do impact investing in fixed income, dedicated to specific projects, and the issuers have to report to us on an annual basis. What are the metrics? What are these metrics that I'm presenting to you? So it's a very tangible way to do it, and it really allows us to model our portfolios. And like I said, to be able to present to our clients, this is what we've done, and this is how better we are versus the benchmarks, and this is kind of where we're going also. Again, so as a conclusion, fixed income was a very tough year in 2022. We kind of managed to do a counter-relative basis because we're well positioned for duration. I do completely concur with what Wayne's saying. Fixed income is back into the game now. So just as an order of magnitude, so I said we started 2022 with an average yield under 2%. The yield starting in 2023 is closer to 4.5%. So it's still not fantastic, but certainly 4.5 is a lot better than 2. And it gives us that bit of a cushion, right? So if we do have a recession and interest rates go down, so that's obviously is going to be more than 4.5% that we should be able to do. But even if rates do end up going higher for whatever reason, we have a bit more of a buffer. So we do think that 2023, we've had 2 negative years of returns in fixed income. It's the first time since the history. We do think that 2023 is going to be a year where we're going to have positive returns, and depending on what happens in the economy, it could be a bit more than 4.5, or it could be a bit less than 4.5. And obviously, we're committed to continuing to move forward with regards to impact investing and sustainability. Thank you for your time, and I'll pass it over to Mike.
Great. Thank you, Sebastien. Hello, everybody. Great to see everybody in person. So today I'm going to be talking about our continued drive for innovation in sustainability and impact. So 2022 was a tough year for sustainable investing as a whole. Sebastien talked a little bit about that. I'll dive into that as well. But for the majority of Genus funds, we're still able to beat the market even with this tough environment and do quite well from an impact perspective as well. And we continue to innovate, continue to get better on the sustainable and impact side. So 2022 was a difficult year for sustainable investing. So you can see on the far right here, the S&P 500 was down about 12% last year in Canadian dollar terms. And if you're a sustainable investor, an impact investor, you have certain sectors or industries that you're not investing in. And these sectors happened to do extremely well last year. So we have oil and gas production up about 70%. We have weapons up about 26%, tobacco up about 18%. Utilities up about 9%, and these are the more carbon intensive utilities. So if you're trying to beat the S&P 500, but at the same time you're not able to invest in these sectors, it was quite a difficult ride for 2022 for most sustainable investors. If you look at ESG indexes, over the past decade, ESG indexes on the average year have actually beat the market, except for 2022. 2022, the ESG indexes substantially underperformed the market. However, for Genus, we were able to do something quite different than our peers. The majority of our sustainable and impact funds actually beat the market, even during this really tough time. So if we look at our fossil-free institutional balance composite, which is all of our balance mandates. So a balance mandate means you have equity and you have fixed income. And these are all for institutions that want to be sustainable. Our balanced composite actually beat the benchmark by over 0.5% last year, without oil and gas, without weapons, without tobacco, without these carbon-intensive utilities. And then some of our funds actually did really well. So up here on the chart here is our Genus High Impact Equity Fund. This is a fund that's trying to maximize the amount of impact that we're making, while at the same time reach financial goals. And it beat its benchmark by almost 10% last year. And of course, it doesn't have any oil or it doesn't have any tobacco, et cetera. So looking into this impact fund, we're going to profile a few of the companies in here. So one of the companies that we have, it's about 4% of the portfolio at the end of last year, is SMA Solar. So SMA Solar is a German manufacturer of solar inverters. They also do energy control systems. They also do energy monitoring. And last year, it returned about 95%. So substantial performance last year. Of course, the world was wanting alternatives to oil and gas. The world was having higher energy prices. The world was wanting more energy independence, especially in Europe. So solar did quite well last year. And on top of that, there were new subsidies for solar last year as well, which really gave solar a boost. It did quite well when it comes to impact as well. So in 2021, it helped to avoid 76 million tons of CO2. It also had a net impact score of 99.97. So a net impact score is a score that we've created at Genus. It's verified by third-party providers. And it measures the total positive impact that a company is making and the total negative impact that a company is making, and then combine those to get a net impact score. So positive 100% is the best you can get, negative 100% is the worst you can get. And in order to get positive 100%, it means that 100% of your revenues have to be devoted to contributing towards United Nations Sustainable Development Goals. And so we see the United Nations Sustainable Development Goals that this company is contributing towards. It's affordable and clean energy and climate action. And almost 100% of its revenue is directed towards these goals. Last year, we also held Vicinity Centers in the Impact Fund. So Vicinity Centers is a green real estate investment trust out of Australia. So it was about 1% of our portfolio in our high impact equity fund, and it returned about 40% last year. So companies last year that were focused on energy efficiency tended to do quite well when energy prices were really high and people were wanting to reduce their overall energy consumption. From an impact perspective, they've been reducing their carbon footprint substantially over the last few years. They've been installing a lot of solar, and then they've also been devoting a lot of their revenue is contributing towards sustainable development goals as well, so about 61%. So we said that 2022 was a difficult year to kind of navigate for sustainable investors and impact investors. 2023 looks mixed. So there's some positives, some negatives. On the positive side for our impact funds and sustainable funds, there is a continued need for energy independence, continued need for energy efficiency as well. And our funds typically have solutions to some of those problems. So that's going to be positive for these funds. There's also large-scale subsidies. So in the US last year, there was the Inflation Reduction Act, which has a lot of subsidies for electric vehicles, has subsidies for renewables. And so that's going to help out a lot of these companies that are within the funds that we have. And then there's continuing healthcare needs. So even though we're post-COVID for most of the world. I know there's different variant spikes and things like that, but there's continuing healthcare needs and, of course, changing demographics, which are leading to the need for more solutions. And we have a lot of healthcare solutions within our impact fund and our sustainable funds as well. On the negative side, as Wayne said, growth is likely to be hurt in this next year, just given that rates are so high. And the companies in the impact fund and sustainable funds tend to be more growthy. just given that they're trying to innovate, they're trying to hire new people, invest in new machinery, invest in new technologies. So if they don't have lower cost capital to help them grow, then that's gonna hurt them in terms of overall growth. And then, of course, with oil prices remaining high and our impact funds and our fossil-free funds not having oil and gas, that remains a headwind for a lot of these funds. And at Genus, we're continuing to innovate and always listening to you, our clients. And so we're improving some of our funds, some of our sustainable and impact funds this year. So we've heard from a lot of clients about a few screens that they're wanting in our funds. One of them being to exclude the top funders of oil and gas globally out of our fossil-free funds. So starting in February, we're going to be excluding the top 10% of funders of oil and gas projects globally. So this will mainly be large banks like JP Morgan, HSBC, Bank of America. A lot of these companies are already excluded because of controversies already. A new one that's going to be excluded, though, is RBC, so Royal Bank here in Canada. They're in the top 10% for funders of oil and gas projects in Canada and globally. And so they'll be part of this new screen. And it's just for the fossil-free accounts. Another screen that we've heard from a lot of clients that they really wanted was to screen out companies that are involved in indigenous conflicts. This is something that we've been wanting to do for a while, but the data hasn't been there. We've been searching for it. We've been asking data providers to create it for us, but we haven't been able to get the data until just recently. So now we're going to be screening out companies that have severe or high conflicts with indigenous groups globally. So we'll be screening out companies like Rio Tinto, Newmont, Glencore, quite a few mining companies, resource extraction companies. A lot of these companies do have controversies already, so some of these companies are already screened out. Some ones that aren't screened out that will be screened out now are Newmont Corp, Fortescue Metals, and a couple others. And we wanted to discuss our custom screening. So we do custom screens for clients. So if you like these screens, but you want even more screens, if you have other values that you want to instill in your portfolio, or maybe you really want to invest in certain things that aren't in your portfolio, we do fully custom screen portfolios for clients. So we have about 5,000 different factors or screens that we can use for portfolios. So we can really screen your portfolio, and that's one of the advantages that we have as a quantitative manager, is that we can do mass screening for clients with enormous amounts of data and factors. There is a minimum size for these custom screened accounts. So the minimum size is 2 million in equities. So if you do have fixed income or other assets, that would have to be on top of the 2 million for the custom screened account. And then we're doing further ESG integration. So ESG integration is when you're baking in environmental, social, or governance factors into your financial decision making. And so there are a lot of firms that say that they do ESG integration. It's kind of a low threshold to say that you're doing it. You basically need to just be considering ESG. So maybe you're talking about it or you're thinking about it when you're investing. Some firms do apply ESG data to financial models. So that's kind of the next level up. It's far more rare than just considering ESG. And that's something that Genus has been doing for 9+ years. But now we're going to be moving on to another level, and we're going to be doing multi-factor ESG models that are integrated into our financial decision making and our portfolio management. So what does that mean? It means that we have back-tested and done a lot of research on different ESG factors and found factors that not only make portfolios cleaner, but also lead to better performance over the long run. So we've combined these factors into a model, and we're going to be using them to help us with buy-sell decisions for our fossil-free funds. So then we'll have more robust and deeper ESG integration. So we are continuing to drive innovation in the sustainable and impact space. 2022 was a difficult year for sustainable investors as a whole, but for Genus, the majority of our sustainable and impact funds actually beat the market even during this tough time. And we're continuing to innovate and continuing to listen to you, our clients, and remain leaders in the sustainable and impact space. Thank you.
Great. Thank you all so much. So just to recap the sort of main messages that have come at you over the last few minutes, we are about halfway through a bear market. Justin took us through, basically that the central bank's action will cause a recession. We do have a recession coming. The recession concerns are really masking those major structural changes that are happening. The good news on the bond front is that we found some success on the bond front, and there will be more to come. And we continue to really, dig deep and be the strong leaders that we are and have been in the sustainability and impact space. So now we'll move into our Q&A period that I mentioned before. We have a few questions that have come through the live stream, so we will get to those in a moment. But what I'd like to do first is introduce Mary Lou Miles to the panel, who she will be bringing the portfolio manager perspective. So those questions, that need that sort of portfolio manager perspective, we will ask Mary Lou to answer. So I will actually start with Mary Lou. If you have any thoughts that you'd like to share, first of all, on anything that we just saw, or if you have a particular question that you'd like to get us started with, please.
I do have a few questions. So thank you for the esteemed panel today.
Is your mic on?
Am I on?
Can we turn that mic on, please?
Mic on?
Try again. Try again.
Try?
Yeah, there you go.
There you go.
Thanks. So welcome, everyone. Yes, I do have a few questions. So I'd like to start actually with Wayne. So, well, that's what portfolio managers do. We put the investment team on feet to the fire, right? So we're on the front line. So the great message we had today. So my understanding is that, so you're looking at for 2023, a better year than 2022, but are you expecting a lot of volatility?
Yes, it's going to be an interesting year. There will be volatility. I expect, we're expecting a bit of a rally here. As the recession hits, we could have another correction. And the thing is, the stock market discounts the real economy by 9 months. So if we anticipate a recession into, say, the Q4 of this year, quarter 4, it should come out of the recession, hopefully, in the first half of next year. So sometime around mid-year, September, we anticipate the market to start getting a little more friskier and anticipate coming out of a recession. And so it's going to be interesting. If we get a soft landing, it's going to be not as volatile. The bottom may be put in place already. If we get a hard landing, we could go from here to another 10, 15%, and then drop another 20% or maybe more. And then recover back to 4,000 by end of year. So I can, depending on the scenario, you'll get more volatility predicated on a hard landing than a soft landing. But it's going to be an interesting year, and we're gunned up. We're on our toes, and we're watching our signals, and it's going to be a fun year.
Thank you.
Do you have any more?
I do, but let's wait.
Okay.
Let's try the audience
Let's try
first.
some audience. I'm going to need to grab this. Do we have any questions from the audience? Anyone? Okay, great. So I didn't mention, but I will mention now, if everyone can keep your questions to one question at a time, please, just so that we can go back and forth. Thank you.
Thank you. China is opening up as after a long period of zero tolerance and lockdowns and so on. I'm just wondering how that is going to impact worldwide inflation and things like oil and gas and other impacts. That could be a wild card for inflation rising again.
All right, so let's go back to Wayne, I think, to start for that one, please. Can you just use that? Thank you.
Yeah, I should have mentioned that during the presentation. No, we anticipate reopening in China, which is could be inflationary in some areas, but also deflationary. It's opening up the supply chains, and so getting more products out there, product pricing can come down. So it's sort of good and bad news story. I think that if it plays into a soft landing scenario, frankly, that if we get some growth out of China, which helps global growth, I think it's going to be a good thing for the global economy. And that's what our models are saying. They're saying global markets look pretty good, but the U.S. doesn't look that good. And I think it's a function of maybe the emerging markets, China, et cetera, coming on with European. And Europe does benefit from a reopening in the U.S. We're starting to see attractive stocks, some stocks in Europe, in the consumer discretionary luxury side that are beneficiaries of China. So there's opportunity there, and Europe it'll mitigate the U.S., it'll mitigate the European recession if China opens up and we get some help there. I think it's going to help the soft landing scenario and be in neutral on inflation.
Okay, fantastic. Thank you. I think we'll go to a live stream question next. So this one came in from Sharon Simpson. She asked us to please name some value stocks versus growth stocks in this new market, and what makes a value stock?
Well, typically, there's not a really distinct line between value and growth, but typically value stocks have lower price earnings ratios, lower price to book ratios, and they're cheaper effectively. Growth, some people say growth is just the opposite of that. It's not. Typically growth has to have some growth in their earnings. It can't be expensive names. Typically growth are more expensive because they do have more growth discounted into them. So that separates value from growth. There's growth in earnings, historical growth in earnings, versus cheap on a earnings price debate. And so right now we're seeing more companies. Apple would be a growth stock, for example, as would Microsoft. A lot of the technologies in that space, some of the healthcare in that space. And value right now is financials are really cheap, for example, right now. We're seeing lots of value in cyclical stocks right now. We're starting to pick away at some of those as they turn. So typically cyclicality. We've moved into some of those value names with the peak in the U.S. dollar. When the U.S. dollar rolls over, it's good for commodity-oriented names. And cyclicality typically. So that's been our reflex over the past quarter, has to start moving into some of the cyclical names that are beneficiaries of our lower U.S. dollar, and those are typically value names.
Okay, fantastic. Thank you. So we'll come back into the room. I'm just going to kind of go back and forth. Any other questions in the room before I go back to live stream? Okay, we'll go. We have oh, yes, we do. Hi there.
I have a quick question on the bond side of things. Any worries about a snowball effect when it comes to this high interest rate environment, recessionary fears, like you were saying for the JP Morgan, they have AAA rating, but the assets that they're investing into are not, and the companies that they're investing into are not. Is there any worries around a snowball effect?
Yeah, I think you have to balance out the credit issues that might arise in a slowdown. But just as Wayne was explaining, so I think a lot of that is already priced in. So credit is actually quite cheap right now in the fixed income world. So so you want to have some, but you certainly want to make sure that you have room to add some if we continue to see a weakness. So it's really the point where you got to balance out. Yes, it's appealing, but you want to make sure that you have the room to put in more. And in the end, it comes down to just knowing the companies and feeling comfortable that you're okay for the credit. But I don't think right now is the time to go in full blast and take on a lot of risk. I think there's starting to be a lot of interesting opportunities within the fixed income space, but I think you have to go gradually because, to Wayne's point, it's going to be a transition year, and by definition, transition years tend to be extremely volatile. So I think there's going to be a lot of opportunities in 2023.
Great, thank you. Is this on? Next one, I think I'll go back to the live stream, and this one will be for you, Justin. If there is a slowdown coming, why is unemployment still so low?
Yeah, so generally unemployment is quite a lagging indicator, so it's much slower to react and respond. We have seen PMIs which are a bit more faster in terms of responses because it's more about a survey with corporate sentiment. So with that, we can see that there is a slowdown there, and a lot of the layoffs currently have been pretty concentrated in more of the tech sector. We haven't seen it filter through just yet, but we'll probably see that move up. Unemployment rates move up going forward probably into this year as it lags the economy usually.
Okay, thank you. Anyone else in the room? hard to see with all of this light. Okay, fantastic. We'll go back here. This one was interesting from Cynthia Owen. You talked about how too much money is chasing too little goods. Are you seeing changes in the supply chain showing up in new opportunities in the companies that meet your criteria? I think there might be a little bit of a typo here, but if you have a reasonable understanding of that, Mike, if you could tackle that one. It's the one at the top there. I think it has to do with supply chain. I think it's supply chain, not supply change. I'm not sure.
I'm not totally sure what they're asking.
Okay, maybe Cynthia, if you can hear me, if you could retype your question, we'll get to it in a moment. Thank you. Okay, let's go to a shorter one. Well, let's talk about Russia. It is sort of the elephant in the room. So, Wayne, we'll go back to you.
Can I have the mic?
Yes, you can. It's right
sorry.
there.
Oh, man. The market tends to discount what it can discount and ignore what it can't. And I think it's probably having a hard time discounting how this unfortunate event's going to play out. I know that I've wasted too much time on this issue in terms of the time I spent on it, and it's going to impact, I think, maybe energy going forward. I think an end to this would be very positive for the market overall, and just in terms of the risk premium shrinking. I really wish that parties would get together and have more discussion. It just seems to be escalate, and that's dangerous in terms of the time before midnight, the 9 minutes before midnight. So that's my concern, is that it's more of a big picture concern versus the markets right now. And the market tends to ignore these things because it really can't discount what's going to happen here. But it's been discounted, I'd say, in the military stocks. In some of our portfolios, we have some of those, and they've done very well, and probably will do well based on the commitments we've seen, just in terms of the West using all their ammunition and munitions and military machinery. So there's going to be a build out there for a long time. Energy is going to be a big play. Energy is going to be a big play anyways, even without the war, I'd say. But it's as I said, the market it's too difficult to discount, and the market often just ignores these issues until they can see more visibility there. And I think there was more concerns about economic dislocation in Europe, for example, and even in Russia. Russia seems to have survived this. Their economy is doing better. Even with the sanctions, they're selling more energy to India and China. In Europe, there was concerns about high energy prices, but they had a very warm winter and mild winter, and that really has helped energy prices there. They also bought a lot of inventory beforehand. So it seems to be, with China reopening, it's going to help Europe get through this, the Russian war impact, or Ukrainian-Russian war impact. So far, so good from a market perspective. I just hope that they de-escalate this and start some kind of détente at some point in time.
Great, thank you for that insight. I'll go back to you, Mike, for another question from Cynthia. Any opportunities on agricultural production screens?
So there's not. So I assume they mean ESG screens around.
I would imagine, yes.
Yeah. So there aren't too many strong agricultural screens from the negative side. So screening out companies that aren't doing things correctly. We do have some genetically modified screens. So any foods that are genetically modified are screened out of portfolios in the fossil-free funds. There are also opportunities on the regenerative agriculture side. So we are looking for companies that are making a difference in the agricultural end, so more of like a positive impact rather than screening out the negative impact. So that's what we're seeing.
Okay, fantastic, thank you. And then we had a sort of more general question. What is the outlook for the Canadian dollar? And I will leave that to whoever wants to take that answer.
Yeah, so as Wayne mentioned earlier, we are more positive on the Canadian dollar relatively to the US. We think that US dollar has peaked in the slide shown by Wayne. So going forward, we do think that the Canadian dollar also tends to outperform during the time when commodities are doing better. So
Yeah, I would just say that to me it has a bit of upside here. Probably next set of resistance probably is around 77 cents. So we have some upside here. After that, we'll have to wait and see.
Okay, excellent. Anyone else in the room? Okay, great. So I will go back to Cynthia's other, she's clarified now. So her question is around changes in the supply chain and how that is showing up in opportunities in companies that we're looking at.
So I can take it from what I think that she's asking. So I think that she's Cynthia, correct us if I'm saying the wrong thing here. But I think what you're asking is, with the supply chain issues, are there new opportunities that we're seeing? For us, we're not really focusing on which companies are benefiting from supply chain issues. We're more focusing on the inverse. So which companies are being hurt by supply chain issues? So earlier this year, when there were more supply chain issues than there are now, we looked at our portfolio and looked at what companies are more exposed, especially to Europe, to Russia, and we cut down our weights or completely cut out our weights. So we cut everywhere that we could with all the companies that were linked to Russia and the supply chain in Russia. We tried to cut down as much as we possibly could. But in terms of opportunities, it's not really something that we're looking for.
Okay, thank you. Now back to a more general question, and probably either Wayne or Justin for this one. How does Genus determine which equities to add to the portfolios?
Okay, well, we're a quantitative or systematic firm, so that means we're very organized and very disciplined. We have a very defined process, what we do. First off, we have around between 40 and 50 stock models for countries, stock models for sectors that rank companies within those sectors and countries based on good fundamentals. And we go searching for fundamentals that really apply. And for example, we have a technology model is very different than an industrial model. Technology models built more in growth and momentum and those kinds of things. Industrial model will have more cash flow, more value into it. So we fine tune our models for picking the right stocks within each sectors. We also look at more high test models that look at high performance across a country, for example, then integrate those with the sector models. We use risk models that'll help us create the portfolio. We'll take those high ranked stocks. We rank the top 2,000 stocks around the world. And then we use risk models to create a portfolio with between, say, 40 and 70 stocks for all our different mandates. And that's why it's so important, I think, in terms of the fossil-free mandates, because with the fossil-free mandates, you're excluding, as Mike has said, big sectors like the energy sector, for example. How do you actually replace those stocks you've missed and get diversification? Well, using risk models, we can go and buy stocks that have higher correlations with energy, that have more economic sensitive, and they can mitigate some of the sensitivity that we lose when energy is really running. So that's a little bit what we do from a stock perspective. Our team also gets together. We have sector models that look at a top-down perspective in terms of what sector is going to perform well, what's going to happen with style, what's going to happen with small cap versus big cap, or risky stocks versus more stable stocks. And we use that from a top-down perspective. We meet bi-monthly or every 2 weeks and look at our sector perspectives that are still in place. We look at technicals as well and have a top-down integrated approach for driving our sector exposures or sector bets. And then we use our top pick stocks. So when we buy a stock, we rank our stocks between 100 and 0. So we'll typically sell a stock when it drops below, say, 40 in terms of ranking, and we'll buy some name above 80, for example. So we have a strong sell discipline. We use risk in our portfolio. We, in a very disciplined manner, rank our stocks every single month. And we go through this process with the team every single month, and we rebalance our portfolios every month. And it's a process that it's a cadence we go into, and we know what we're doing the first week of each month.
Fantastic. All right, so that will actually wrap up the Q&A session. So for those of you on live stream, you will have the opportunity, if you've put in a question that did not get answered, we will endeavor to answer all of the questions that came in through live stream. For those of you who are in the room, feel free to stick around. All of the team will be staying in the room as well. So the investment team, the portfolio managers, if you have any other questions or anything you'd like to talk about with them, please feel free. I think we have quite a bit of food still left over as well if you didn't get a chance to have a coffee and a bite to eat. And a couple of things before we wrap. I would like to, first of all, express my gratitude to all of you for making it down here today, and for all of you online for joining us. It was wonderful to have all of you, whether you are a client or whether you are new to Genus. I'd also like to take a moment to acknowledge the team. It truly takes a village to put on any event, particularly if it's a hybrid event. So there were many people that went into the production of this, so thank you all so much. And we will have a survey for those of you on the live stream. If you can stick around for a few seconds after this, the live stream ends, you will be automatically directed to that survey. And we would really appreciate your feedback as to how you found the event. For those of you in person today, we will be emailing you the same survey. So again, we'd appreciate your feedback on how you found the event. We're always looking to improve. The last thing is we are going to be sending out an email to everyone who registered for the event with a recording. So you will be provided with a recording so that you can, stop, look at the slides, whatever you need to do. And there will be an availability of that as well on our website in case you would like to share it with anyone. So with that, we will wrap up the live stream. Thank you all for being with us. And for those in the room, thank you for being here as well, and have a fantastic day.